Wonderful. So our mandate today is to talk about the state of venture. So I have some very broad questions, but in each one of those broad questions, I think if we can focus on upstate New York, we're in an upstate capital event, I think that would be helpful. So 3 broad categories. So deal flow and valuation. We're going to talk about AI transformation, but not necessarily for startups, but AI transformation for how you guys are sourcing deals and how you're managing your funds. And then the third is exit environment. So we'll try to get through all of those very large topics in a pretty short time. And I already forget how much time we have, but Noah, I'm sure will tell me that we have to stop at a certain point. So first broad question. So how has the current economic climate impacted deal activity and valuations? And what trends do you see in the future? And again, kind of focusing on upstate New York. Anyone can take it away. Well, we can give David Brown the floor since I ignored him in the beginning.
Appreciate that. So, I think this last few years has obviously been very interesting, right? You think about kind of the 2021 boom and then everything that's came after that. What's been interesting, I think, in upstate New York is a lot of the highs and lows that you're experiencing in some of the bigger markets don't necessarily permeate themselves in the same way. So what I mean by that is valuations have actually been relatively consistent. I would say, in my experience, some of the startup activity has a little bit quieter to return versus what you might have seen in the bigger markets. But the quality and caliber of the entrepreneurs in the upstate New York area have really started rebounding very quickly in the last 6 months, I would say. And you're starting to see a little price uptick, but generally the prices in the last few years have been relatively stable.
So I would say that I agree that the prices in New York, in general valuations are, they're relatively consistent, although I would say it also depends on your stage. So where we invest, which is more often at the Series A stage, in general, it feels, that we're more of a sort of Series A crunch sort of environment, which means that for those funds like us who are actively leading Series A rounds, the pendulum has shifted a little bit more to people at stage, and I would say, I'd love to hear what Kian has to say about the growth stage. I know that's also, things have slowed down a bit within that sector as well. I'd say one thing that I'm really excited about over the past year in terms of how I look at 2024 compared to, say, 2021, which was obviously an incredible year in terms of exits for our industry, is that it feels like where last year a lot of people were trying to recover from the SVB crisis, the FRB crisis, the banking crisis, the tech correction, it feels like things are leveling out a bit. And now we're seeing a bunch of companies, if they're seeing product market fit, they're going out to raise. If they don't have product market fit, they're either working toward an exit, which we can talk about later, or a path to cash flow break even. So I think those are a few things I would note about what I'm seeing in upstate. The other thing that I'm really excited about in upstate, and this really started even before the pandemic happened, is just the net inflow of talent to this region. And as many of you are aware of the Micron announcement and TTM and numerous other companies that are making really big bets here in upstate New York. From our perspective, we're really excited about the second and third order effects in terms of additional talent we can tap for companies, as board members, advisors, or operators. That's something we're really excited about.
This will not be specific to upstate, but it will be specific to probably later stage investing that we do relative to someone or David. But it's probably worth just letting everybody know what actually happened. I started calling what happened in 2022 a great reset. I think it was a really positive reset in the technology markets. We had seen this really big run up in valuations, sort of from just as we kind of went into COVID and during the COVID period, just to give you a sense of the numbers. And this is all just software specific. So sort of selfishly just speaking to my own industry, but we were at, for the last 12 years or so in the public software markets, if you could just the growth software companies, so not NVIDIA or Microsoft, really the small to mid cap growth public software companies, the average software company was trading at about 8 times revenues over that period of time. But from 2020 and 21, starting in 2019, that 8 times went up to as high as 18 times by the time you got to the fall of 2021. We then had the pesky problem of inflation emerge and a sort of 6-month period of interest rates going up as high as they did. And that had a dramatic impact on the public valuations. So that 18 times, which was the peak in Q4 of 2021. By the time we got to the summer of 2022, that had gone down to 5. Extremely low, much lower than the long-term average. That number has not changed. So if you read about the Nasdaq being up and all-time highs being reached in public stock markets, it is not the small to mid-cap public software companies. They are out of favor. I've never seen them out of favor for so long. They've been out of favor since the middle of 2022. Has that translated into the private markets, so where we're investing? It's taken a while. What we see with public markets and in the private markets is when the public markets get very frothy and valuations go up, the expectations of the private market owners go up almost in lockstep. But when the valuations go down, shock horror, they're not nearly as willing to go down. There's a lot of friction on the way down, and it takes time. I would say we spent most of 22 sitting on our hands, waiting for the markets to adjust to this new reality. Not knowing how long it would last, but it just felt risky to deploy capital at that period of time. We wish we could have been more sensitive a year before, because we were very active in 2021 when the value markets were up here. So we're paying for some of the sins of that. And trying to recover it in a more attractive environment, certainly from a valuation perspective. But it did at the stage where we're investing, we did see valuations adjust. Now it's not an apples to comparison with the deals that these guys do, because they're doing generally I think further stage than us. But I would say the deals that we're doing today are being done at about a 65% lower valuation than a comparable deal that we were doing in 2021. So we have seen an adjustment. I think it's still going through an adjustment. One of the things that happened in 2021, particularly in venture, is that with valuations being so high, relatively small companies raised quite a lot of capital, more than we'd ever seen. And at the time we were quite negative. We had our own portfolio companies out raising a Series B or Series C, and they'd raise quite a large amount of capital. We'd say, why are you raising so much capital? And it sort of seems like you're making your cap table very complicated. But in hindsight, they were right and we were wrong, because they raised capital at quite high valuations with minimal dilution, and they're sitting on very healthy cash balances today. And so I would say one of the risks in venture is that there's a lot of capital has been invested in 2021. A lot of companies have raised capital in 2021 that have not raised capital in 2024 yet. Some of those companies are raising very well, are performing very well, and they'll have up rounds from their last round. But lots of companies that if they're not right on the plan of what they were projecting, there's maybe a bit of a reckoning to be happening. So I'm not sure we've seen the full effect of this reset in the public markets come into the private markets yet. If we're talking about artificial intelligence, for example, there's been no reset. If you see the valuations of the venture rounds that are happening in areas like AI, there's just it's like 2021 for sure. But other pockets that I'd say generally where we're doing deals today, we are seeing the benefit of lower valuations.
Yeah, I had just a quick follow-up question for you two, investing a little bit later stage, right? So one of the things that we talked about is obviously at the early stage we've seen kind of a flatness, but one of the pieces that we are observing, right, is during the 21 period, a lot of the bigger firms were starting to seek alpha in secondary markets or emerging tech hubs. We've started to see that dry up, and I'm kind of curious from you, Kian, as you looked at your own investment strategy, has it shifted back towards the hubs over the last few years?
You mean geographically?
Yeah.
No, I would say not. It's funny with us. The geographic picture can sometimes be a bit random. So, for example, Israel, skews very early stage, and we're not that active in early stage right now. So there's not a lot of activity, so we're doing less there. Someone asked me in 2022, I mentioned earlier that almost a third of our capital gets deployed in Europe. In 2022, I assumed that we would do less, given all the geopolitical issues in Ukraine and all of that. And it's actually been one of the areas we've been most active. So contrary to my expectation, we're actually very active there. What we're finding, it's interesting you mentioned secondary, so we're finding a lot of opportunities to do buyouts of venture-backed software companies, where we have VCs that have ownership of companies that are good companies. They're not amazing companies, not going to be the next companies that go public where you hear about them, you read about them in the front of the Wall Street Journal, but good companies, but they have ownership, VC owners that need liquidity. They need to generate DPI for their LPs, they need to send cash back, they need to raise another fund. And whereas in 2021, they were very uninterested in selling to us because the public markets were wide open and they had other options in terms of exits. Today, they are actually willing to sell to us. And by the way, they're not distressed sellers. They're making very good returns at the prices that we're buying at. They're not making what they would have made in 2021. But that's actually been, I'd say, more than half of the capital we deployed in the last year is in secondary transactions, buying out venture capital firms and sort of taking those companies on under new ownership.
From my perspective, I will say that when I look at the last 10 years that we've been active, and I look at the amount of other capital sources, whether they're at the Series A or beyond, investing in our region, I think we're finding that if we're involved with companies and we're looking for the Series B and C, this is very much a relationship-based game. And so for funds that we've worked with before, I'm sure you guys see this too. It gets, it's still very easy. It's still very feasible to get them to come and participate as B and C. But in terms of people that we're competing with in this market, I feel there's less competition. I feel like the AI boom, which we'll talk about later, has, I think, sucked the oxygen out of the industry. And I think a large amount of our venture dollars are being concentrated in a lot of companies, especially in Silicon Valley.
So maybe Frank, this is a moment to turn to the pension fund, right, and talk about the pension fund's willingness to provide capital to venture capital funds to provide liquidity there. So just a note, as I mentioned at the beginning, New York Ventures has a pre-seed seed fund, which was funded by federal dollars by the SSBCI. And I will say that we've seen tremendous interest from New York companies to receive pre-seed seed investments. So I do think, and we talked about this a little bit yesterday, just over lunch, which, there is still a need for capital in upstate New York. I will say there are more deals than there is capital. So maybe this is just a moment to talk about, the pension fund as a source of capital for venture funds.
As I mentioned, we're active across stages. We are a very active seed investor, not only in New York City, but also in upstate New York. The trick for us, being a large institution, we have a lot of legal requirements and compliance, and I could go on and on about how bad it is. But so it's very difficult sometimes for us to access managers. In a perverse way, the fundraising issues of private equity generally over the past few years has actually been a huge benefit for us, because name brand venture firms that for 20 years would never talk to us are now our new best friends. And I could mention names, but I'm sure most of you probably know who they are. I think for us, the hardest thing, and it's the hardest thing in investing in venture generally, is selecting the right manager. And we spend a lot of time, I personally spend a lot of time meeting with new managers, new funds, kind of assessing where they are in the market and are they going to provide us alpha or provide us access to deals that are going to yield above market return. And it's a full-time job. We've been doing this for 20 years, and we have a lot of bad experiences to build off of and to hopefully not repeat. Because of our size, because of our patience, we can afford to be very selective. And we take advantage of that. And we're very proud of the fact that we have a very concentrated portfolio. I would bet that we're well over 100 seed stage companies across New York State. But our manager stable is very concentrated, and that's on purpose because we can afford to be very selective.
Okay, so let's switch to AI, and I think a lot of times in conversations we're talking about AI companies, right? And kind of this moment of AI overtaking a lot of the, I was joking with a couple of founders that, all of a sudden everyone's pitch decks had AI in it. But I think today what I want to talk about is, your use of AI, and especially if you're using AI in any way to source or evaluate deals. And if you're not, if that's something that you're thinking about, or is AI not going to be a tool that you use in finding and evaluating companies?
So and one thing that in terms of your question about how we look at AI and using AI ourselves, I'll try to answer both. So in terms of how we at ASV look at AI, I think that we look at AI as a tool to help solve problems, again, in old line industries. So I think a lot of companies that pitch us and say that they're AI companies are really often, ChatGPT wraparound tools that are serving niche things. There's really nothing fundamentally AI based about the company, that they might use certain tools, whether it's Anthropic or ChatGPT or tools like that. And so I think what's interesting is that one of our friends in the Silicon Valley put it best to me, was that when you think of when Kleiner Perkins raised their venture fund in 1997, I think they told their LPs, we're going to raise this thing called an internet fund. And everyone's like, that's amazing. What's an internet fund, right? And of course today, pretty much, if you're not a life sciences biotech fund, you're an internet fund, right? And I think so AI is, I just think, ubiquitous. It's going to be part of every single company. And what we really look at as investors is how, if there is an AI component, is it creating scale and moat? And ultimately, that's the hard part, I think, with AI in general, because when we were, Keen, you've been doing this even longer than I have, right? Like, I think when we used to focus on a B2B software company, we thought that with this round, we would have a 12, 18-month runway to ultimately help create something defensible. But just as we're looking at a company, this happens every week, right? Anthony, Jen, and Rodney here from our team, like, just when we're looking at a company that claims to have this breakthrough AI technology to solve marketing or recruiting and sales, the next day, Apple announces a new product that just completely, disrupts that, or Microsoft or XY. The incumbents in this space are playing a very, very large role, right? One thing that we also are excited about on the AI side is, I mentioned Micron earlier. Whether you look at Micron or NVIDIA, these are really these, companies that are providing the infrastructure, right? The actual picks and shovels for AI, and we're excited that a large amount of activity is now going to be happening in our backyard. So for us, if there's opportunities in terms of application software to help address those industries, that's something we're very excited about. Internally, though, in terms of how we're adopting AI, I think we've started small with like certain tasks, right? Things like, note-taking and project management, integrating with our own CRM system. We're really on the, we're just beginning to explore opportunities to use LLMs to actually help us with qualification reports, helping us estimate market size, helping us do competitive benchmarking. I mean, we feel right now that at least the early demos, there's still a lot of the data that comes back is a little hit or miss, but I feel we have to practice what we preach as investors, and there's an opportunity for AI to really help enhance our efforts. And one last thing I'll say about AI is just that I'm very, very honored to be working with Governor Hochul and a bunch of other CEOs, the CEO of Micron, the CEO of M&T, the CEO of IBM. We're working on an initiative with your colleagues at the governor's office to really allow New York to be a leader in AI-based innovation. And we had our first board meeting 2 weeks ago. I thought this was just a nice little kind of press op event, but it wasn't. It was actually, the people are really, really committed to making New York a leader here, and that's something I'm very excited about.
Yeah, I guess I'll talk about how we're viewing AI, and I'll talk about how we're using AI internally. I think it's really interesting. There's something there. Unfortunately, in our space, when there's new technologies, they're always accompanied by a lot of hype, and you really have to sort of cut through what's real and what's not. And we're talking about companies talking about AI on their pitch deck. Companies have changed their website address, instead of putting .com to put .ai, things like that. So there's a lot of hype. We see it, I think, very similar to what Somak said. We see it evolving in a different way from other technologies. It's definitely a platform shift, or some form of a platform shift. And normally when we see a platform shift, we see that the startup companies have an advantage and the incumbents have a disadvantage, meaning that the incumbents can't adapt to the technology of the new platform. We saw this when we moved from old on-premise software to the cloud, where the cloud software companies, the companies that were born in the cloud era, had an advantage of those that were not. If anyone remembers a company called Siebel, it was one of the first CRM software companies. They didn't adapt to the cloud. They ended up, being acquired by Oracle, and Salesforce came along and said, well, everything's in the cloud, and lo and behold, $200 billion plus market cap today. So that's normally what we see with new technology platforms. We're not seeing it that way in AI. What we're seeing is that when this generative AI came out a year and a half, 2 years ago, it was a big surprise to a lot of people, including ourselves. And one of the things features about it is that it's quite easy to implement into your software product. So if you're an incumbent software vendor, and you have a product and you feel you can augment it with AI features, if there's a benefit in that for your customers, that's actually not that hard to do. And so the technology barrier is not as high as it used to be. And so when I say, so it's sort of like, normally if you think of a dial in any given market environment, and in our space, it's normally dialed towards advantage towards the startups. And it's kind of like the dial has been turned the other way, it's more advantage towards the incumbents. To give you an example, we're tracking about 350 very early stage AI startups at the moment. And about 10 of them are going after either Microsoft PowerPoint's products or Adobe Photoshop, which is very good use of AI. So the idea is, you could create, someone could record our conversation here today and use AI to actually create a presentation that summarizes our discussion. Very good use of AI, that's very possible. And so these companies are coming up with new versions of PowerPoint that have AI built into it, new versions of Adobe Photoshop, which is a design product with AI built into it. The only problem with that is there's two companies that already have those products released. One is called Microsoft, and the other is called Adobe. So good luck with your startup. It's going to be really tough. And so that's very different. We've not seen that before. So as much as there's a lot of interest and there's a lot of potential, we're ascribing a pretty high degree of risk to adoption on the earlier stage side. We see a lot of companies that are sort of putting a wrapper around an existing, a large language model, but really don't have a lot of IP themselves. So I would say, I could paint a picture of glass half full and glass half empty. The glass half empty is really that customers are in experimentation mode. We speak to a lot of the customers of our portfolio companies. We met Goldman Sachs recently. They had over 200 generative AI projects on the go inside their organization. Very interesting. However, we don't know which ones will be successful, and they won't all be successful. What's the ROI going to be? So it's quite hard to invest in a market where the customers are really in experimentation mode and you don't know what's going to stick or what doesn't. So that's kind of the glass half empty. The glass half full is that, what we also see in platform shifts is that the early beneficiaries is typically hardware and infrastructure, and then the software comes later. So, when this came out, whenever it was, the big beneficiaries early were obviously Apple and companies making phones, companies making mobile infrastructure, and organizations rushed to kind of build infrastructure around mobile. And then within a year or two, you saw the software applications land on top. You could argue we're at the same spot in AI right now. So who are the big winners? It's AI, which is the chip, which is the hardware. It's NVIDIA, which is the chip, which is the hardware. Companies like Microsoft with their cloud services, companies like Amazon Web Services, Google Cloud Services. These are the infrastructure upon which the AI applications would sit. And so the glass half full is sort of saying, well, we're just at the normal sort of evolution of this, of a technology shift. And actually, we'll be sitting here in 2 years' time, there'll be a lot of applications that are from startups that are, really doing interesting stuff and driving real ROI. In terms of how we're using it internally, we've been doing some form of AI for about 6 or 7 years. I didn't mention at the start, our model is we cold call every private software company in the world and profile them in a database. So if you're a CEO of a private software company, I'll apologize for the amount of times that we've called you over the last number of years. We do have 80 people that do that. It's kind of an AI problem because you come into work in the morning. I started in that team in 2003. You come into work in the morning, like that database has 235,000 companies today. Where do you spend your time? And I used to do a random walk through the database and figure out which companies I would call, or I just kind of in my own head try to focus on a subsector. About 5-6 years ago, we sort of said, well, maybe we can sort of there's a lot of data signals that we could take and use AI to kind of create a dashboard for our analysts that are calling the companies to sort of say, well, here's 30 companies based on the data related to these companies that we think might be closer fit for our strategy. So we started doing that 5-6 years ago, and there's no magic bullet here. It's not spitting out the perfect company, and don't even call it, just send them a term sheet, send them the money. It's great. Yeah. So it's a relationship business, right? Like CEOs of private software companies and founders, they care about who comes into their business. And so the problem in getting into these companies is often not finding them. It's actually winning the deal and winning the entrepreneur over. So there's no magic bullet with AI from that perspective, but it is a productivity tool. And we find if we can maximize the amount of time our team is speaking to companies that are closer to a fit for our strategy from a size perspective, that makes sense. So we started doing that 5-6 years ago. That was pre-generative AI. Roll, 2 years back, you roll forward to that point 2 years back when the new version of ChatGPT came out. We're like, oh wow, this thing is actually getting pretty good at reading and writing. How can we use that? And so we've been experimenting with that. I'm not going to say we got stuff that came out at production level that is driving great productivity or great, investments at the firm. We're like Goldman Sachs. We're in experimentation mode. We are having hundreds and hundreds of conversations with our portfolio companies about implementing AI inside of their products. So a lot of our companies are incumbents in the way that Microsoft is an incumbent in a given market. So we see that as a good opportunity. So we're recording those conversations, and then we're running that through ChatGPT to say, okay, give us a summary of all the last month's conversations with these teams at our portfolio companies, because we're recording them on Zoom, and sort of say, okay, what are the key outputs? Please summarize the key findings, what seems to be working and what not. And then we're taking those summaries and giving them back to the portfolio. So there's things that AI is good at in terms of processing large amounts of information, unstructured data, and sort of reading it and giving some outcomes from it. We're putting our investment memos through the same process. Is there some magic nuggets that we can find from our investment memos that would say, well, all the deals that have this characteristic are your 5Xs, and all the deals that have that one are your 0Xs. Do more of those. So, but very early. We're just sort of we're throwing a lot of effort at it. We have 15 people that are spending a lot of time on it, but it's very early in terms of how we're using it internally.
Just at the opposite end of the spectrum from a firm like Insight, just to kind of set it, I would say within 24 hours of the release of ChatGPT, we all got an email from our IT folks that you are all prohibited exclusively from accessing or using or doing anything involving ChatGPT. And a year and a half later, that has not changed. So the use within an agency like ours is close to zero.
It's probably good for us managers. It means it might recommend that you don't invest in us. So we're probably better off that you can't use it.
But just broadly as an investor, I think, my first reaction to ChatGPT and kind of the evolution of AI was that, this is the next shiny object. And it's certainly proven to be the case. The attention, the level of media attention, the level of public attention to it, I think that's proven to be correct. From our perspective, in fact, we have been investing in companies that were using machine learning for various applications as far back as 2016. So this wasn't really news to us. And the question then became is how is this going to evolve? And to Kian's point, I think it's evolving about the way we expected. And if you look at the SaaS model, where there is probably not a sector of the economy in the United States today that does not have a specifically designed SaaS application, for that particular economic vertical. And I think the obvious point of evolution would be that, well, those companies or some future competitor is just going to simply not only adapt that vertical specific software, but simply incorporate AI into it. And as Kian noted also, the obvious winners are the big four right now. And the question for investors then is, how is that going to play out? Are there going to be investment opportunities that are going to generate sufficient returns? But we like everyone else is kind of watching how this plays out, and and relying on people like Dave and Somak and Kian to kind of give us that broader insight of what they're seeing. And I won't say it's affected our decision making. We understand we have managers like Insight I know a lot of the large buyout firms have built their own internal models, but at some level it becomes an issue of data security as well, where Blackstone does not want their investment memos incorporated into some machine learning model somewhere. That won't impede development, but I think it's going to make it more expensive for the companies themselves. And to the extent that it affects the broader market, we just don't know at this point.
Yeah, I mean, I look at it and kind of say we are still day one when it comes to AI. I think, Frank, you said it right. AI is an evolution of machine learning, which was an evolution of big data. So these concepts or the dialogue around this has been here for 20, 30, 40 years, and we're just getting to the compute power to start to make real use of it. What I think is interesting, though, is if you're looking at the investments that are already out there, as we're looking at from an investor perspective, so many things are just sitting on the periphery because we don't actually understand a lot of the development cycle that the big four are actually putting out there and the next evolution. So we've already seen wave one of all these companies that were super exciting. ChatGPT released their newest version, killed out probably 250, 350 legitimately funded companies overnight, if not more than that. And I think you're going to see that with each release and version. And so as we're looking at investments, we're looking at two things, right? One is how actually independent are your models in terms of what you're trying to build, because if you don't have independence and you don't have something unique, it's going to be really hard to defend it over the long term. And then two, how are you as the founder utilizing AI for your own development? And it's weird because you asked how we're using it outside of maybe like some investment memorandums to simplify my life and some quick modeling, like not a whole lot. We're using it to help, some of our companies find the right downstream partner. It's really useful for starting to search through and finding other alternatives for that. But from an individual founder perspective, we just had a conference on the Finger Lakes, and we had a boat that went out, and it's a bunch of guys who lead the AI, revolution right now, and they're like, we're only 5 years away from a headless public company. There is a chance that there will be a 0 employee company or 1 employee company because of the amount that you can start to leverage yourself. And it sounds far-fetched, but they had really good explanations for how that could happen. And so I think it entrenches the incumbency on one side, but it also allows the startup world to get cheaper and quicker if used correctly. And so I look at how our RCO is thinking about the adaptation of the technology within their own operations, even more so than how it underpins the core of their business.
Last category, and another two-part question. So for exit environment, I guess I want to just know broadly how you're seeing the exit environment for startups. Then also specifically within your own portfolio, how you're maximizing value and what strategies you're using there. And I'll leave it at that open-ended question.
Yeah, I mean, I think for us, it's kind of an interesting point, right? We're now 4.5 years into Fund 1. We typically look to exit companies anywhere from years 5 to 9. That's kind of our sweet spot. And we're starting to see pressure from our LPs saying, hey, it's time to turn this on. It's time to start giving some capital back. And we're looking at it and saying, guys, you want us to sell a really high performing company at one of the worst points in the market, because it's still, if you have anything at the Series B, C or onwards, it's a really hard exit environment to get going. The public markets aren't as open and free as they should be. I'm going to guess you probably have 2 to 3 more years before you really see that, but probably 2 to 3 more years, in my opinion, until we start to see robust M&A activity again, and that all depends on how the public markets kind of support it. And so I think we're kind of stuck in an in-between zone, where one, it's hard to get to that next round of funding. We were talking about that Series A gap, just to illuminate it. In 2021, there was 1 Series A round being done per seed round being done. This year, that's 5, right? It's 5 to 1. So you're getting 5 Series C deals done for every 1 Series A done. And so the push to actually getting to profitability and sustainability isn't just a VC mantra, it's actually a real survivalship thing until these markets start to loosen up and allow for more opportunities to start to accelerate. So I think we're still in a wait and see period right now. A lot of optimism to be had, but I don't think today is a great time to be trying to sell a business.
I definitely agree with that. I would say on the exit side, I mean, there's a Kenny Rogers song, right? Like, you know when to hold and when to fold, and you know, it's actually really one of the most difficult parts of this business is actually knowing when to sell. And I think I know that in 2021, I'm really grateful I listened to my partners when they said, look, let's make some distributions this year. And we're fortunate that we distributed enough cash and stock that year to do multiples of everything we've raised so far. So we're very happy that we've made some real distributions to our LPs that takes some of that psychological anxiety that I think many of GPs right now are facing who haven't had those distributions. That said, like, it's still a very challenging time for exits, as Dave noted, right? So I was looking at some data that my team was compiling for me, and there was an interesting stat that Anthony found, which said that 2,300 companies went into bankruptcy this past year, and looking at this number, I think it was at least 25 had raised more than 100 million of venture capital. This is the highest figure rate since 1998. Right? So it's obvious, when the tide turns, who's swimming naked, as Warren Buffett says, like, the companies with really resilient models, with strong unit economics, with strong product market fit are seeing opportunities, but many other people are trying to find a home. Now, a lot of these companies that are acquirers are sitting on trillions of dollars of cash on their balance sheet. So it's not like, for the right type of opportunities, like you saw, was it last week? Was anyone here were you investor in WIS? Are you, congratulations on that. So yeah, that was a great outcome for you guys. And Frank, thank you, good job there. What was that? It was obviously incredible, one of the largest exits ever, right in the cybersecurity space. I'll let Ian actually go ahead and talk more about it. That's amazing, congratulations. Right, but so there are certain sectors like cybersecurity and defense and other areas where there is real uptick in growth and there is real M&A happening. But I think one thing that we really are spending a lot of time with our companies right now is really helping them understand the whole exit planning process. Because I remember, when I started in venture in the early 2000s, it was the norm when you were raising a Series A or a Series B that you were maybe spending 50% of your efforts in really thinking about who are the right frenemies I should be talking to, because if this round doesn't happen, at least I have a potential path to liquidity. And that's just a skill set that many entrepreneurs over the last few years didn't really develop, because it was always assumed like clockwork, every year you're raising a large up round. So I think that's we're spending a lot more time with heads of M&A, heads of corp dev, and really trying to introduce those people to those founders very early in the process so that they can develop those relationships years before they need to cash those checks.
And so on exit, so look, it is a tougher, it's definitely a tougher exit environment. I will say on Wiz, it's just a Wall Street Journal article. Nothing's been announced. So Google is a public company, so I won't say anything more about it, but we'll see. On the exit environment, look, private equity has probably never, I shouldn't say never, but certainly in my time, I've never seen private equity under so much pressure for distributions from its limited partners for very good reasons. So there's a lot of pressure at a time when it's not that easy. If you're, and this is just general, right across private equity, from large cap buyout to mid cap to small cap through to venture capital, I think there's pressure across the board. And in buyout world in particular, it's tricky because the leverage is not as plentiful as it was, and it's twice as expensive as what it was. And so, if you haven't adjusted your model to sort of an LBO that means you might have a little bit less leverage and you pay twice more for it, then your exit might be a bit tougher just if you're just looking for a private equity exit. Look, we had a good year, actually a record year of distributions in 2021, but it should have been more. We should have been more sensitive to the fact that something might come around the corner, and it did. And we had this big reset in the markets, and we missed an opportunity to sell a lot of companies that if we were selling today, we'd probably be selling them at the same price we would have done in 2021. So we would have been better doing it in 2021, clearly from an IRR perspective. So we've taken a lot of lessons from that. We've formed a whole team internally. We call it a liquidity team that's focused on being much more proactive around our exits and our exit processes. We actually have a 2-year pipeline of everything that we're going to try to sell over the next 2 years, and it's a rolling thing that we update every quarter. And that's just trying to get better at this stuff in an environment where it is harder. Like, the public markets are not open. I don't think they'll be open for a while. We sell a lot to private equity. Private equity is active, but not super active, not like what it was 2 or 3 years ago. I will say the one bright spot is that we are seeing strategics be very active, probably the most active that I've seen in my time. We got a 30-minute meeting with the CEO of NVIDIA in December of last year. And we had a feeling we could try and make it longer. It ended up being a 3-hour meeting, and he was great. And he listened us out. We presented 10 companies to him, and he bought 3 of them, which was great. And it was great outcomes for us. He is a $3 trillion market cap. I think that money that he spent on those companies fell out of his pocket when he was walking into the meeting. He won't miss it, but it was great for us. You know, finally, after quite a while of sitting on the sidelines and the strategics struggling to compete with the valuations that the public markets were offering companies that were going public, and now knowing that that door is shut and knowing that they're sitting on, you know, elevated market caps with decent amount of cash, they're putting it to work. So that's kind of the bright spot. You know, we'll see how it evolves, but yeah, I don't see the pressure on distributions dissipating any over the next couple of years. So I just think private equity firms are going to have to be creative. There's a lot of different ways that people are looking at exiting things these days, but I think it's a really interesting time from that perspective.
And, you know, it's heartening to hear that strategics are taking more of an active role, and I certainly, you know, hope that continues. I think just generally, you know, if you're going to invest in private equity and or venture capital, generally, you have to have patience. You have to be very patient, and you have to understand the cycle of building a business, growing it, getting the right management team in place, et cetera, et cetera. Those things take time. We many times have been in conflict with our peer pension funds who are pushing for liquidity. And, you know, in many cases in these continuation funds, we will simply roll over our investment because we are more patient. You know, because we have such a large and diversified portfolio, you know, our net cash outflows kind of, you know, vary year to year. And, you know, so it's not unusual for us to be cash flow negative one year, but then come back the next year and be significantly cash flow positive. And our senior management has been very patient, thankfully, you know, with a lot of preaching and nudging. And so it's not an issue for us. You know, obviously we love to get big checks, you know, like everyone else. But on the other hand, we don't want managers to sell prematurely. And we certainly don't want investors, you know, getting out of alignment and substituting their priorities for what's best for a fund generally. You know, with regard to venture itself, you know, I think my only concern is we do have, you know, there are very large unrealized portfolios out there. And the question is, you know, how many IPOs would you have to undertake, you know, to generate the kind of venture returns we've gotten over the past 10 years? And it's a big number. And you wonder at what point or even can the market absorb that kind of volume? And, you know, we'll see how it plays out. But if the business fundamentals are there, it's a well-functioning business with, you know, high margins and strong cash flow profile. There's no reason to rush to sell it from our perspective, you know, because I don't want to say we don't need the money, because we do appreciate it. But at some point we don't need the money. We're not begging. My next commitment to Insight is not conditioned on the fact that I get some large distributions from venture capital. So it's a unique perspective, and it does present a lot of problems for large investors like us, because it creates the potential for conflict with our peers.
All right, great. I think we'll end it there now. All right, perfect.
Those are the points. Good.